Okay, let's answer some questions from the last market outlook. Let's see, for rates, can you go more in depth on how these par rates are being derived? More specifically, how yields are interpolated from the daily par yield curve and what is meant by constant maturity treasury rates. Well, they're not being interpolated from the par yield curve. They're being interpolated from market yields on tradable bonds to create the par curve. So I'll just draw a upward sloping yield curve. There is the 10-year. The par curve is saying if the Treasury issued a 10-year bond right now, what yield would it have to have such that it would trade at par? In other words, if it were a $1,000 bond, what would the market like to see as the coupon such that it would trade as a $1,000 bond, not at a discount or at a premium? So what is the market yield that they want to see on that? And to get that done, they look at bonds that are in and around that 10-year, and they interpolate. They just assume some kind of relationship between it, and they'll interpolate what that would be as close as they can, that if the Treasury issued a bond, a 10-year bond at that moment, at that yield, it would trade for par. And that is why this is called a par curve, because the yields on each of the bonds on this curve is the theoretical coupon that the bond would have to have that very second to trade at par. I would like to know how these outlooks are created. What process do you go through to make this? Well, that's an easy question and a hard question to answer. The easy question is just follow along with the video. I start with rates and then I move into other things. It's a very top-down approach, and when you're doing a top-down approach, you'll always start with rates because those rates, the risk-free rates, are the discount of every single cash flow. That is the beginning of the discount process of every single cash flow out there. And rates take center stage right now because of the Fed. The market basically is the Fed at this point in time. There are other times where the Fed is meaningless to the market, where they'll have a meeting and nothing changes and nobody expected it to change and it's just a bunch of nothing, and other things are important. But right now, that's the most important thing. Is it just looking at Fed data? More than that, and incorporating your knowledge into assumptions. Any resources you recommend for someone to develop their own outlook report? Yeah, if you look at every market outlook and you look in the description box, I give links to everything I use, and it's all they're all links to free sites where you can get your information. In fact, if you have a Bloomberg terminal and you are searching for some of this information, Bloomberg simply aggregates a lot of their data. Not a lot, like some of the stuff they have themselves, but a lot of the data that's available is aggregated. You can write your own script to aggregate your own data and create your own little terminal, and it'll aggregate data from different sources. And that's all it is just, you know, depending on what you're looking at and what you're doing, you'll look at different data. So if you were interested in a particular type of, or just one sector of the economy, in time you would find the important information for that sector of the economy, data that is critical for the drivers of growth and profitability in that sector. It's just time and experience, and you know, a good bookmark in your browser of all the free sites that are available to you, and in the description box you'll find a whole bunch. You mentioned S&P Global data suggests forward 4-quarter EPS is 220-201, but the market might think it is higher. Yeah, and the market might think it is lower. That's the whole idea behind estimates. Is it's never just one point. What it looks like is this. There is 221.01, and you have some estimates that are higher and some estimates that are lower. This is the consensus. When we say the consensus, is you take all the estimates that it could be and you take the middle of that distribution. Yes, some people think it will be higher, but because it's a consensus and it's an average of everybody, there are people who also think it's lower. And you may have some people over here from well-placed firms, but you have people over here from well-placed firms. So in the markets, whenever you see a point, there is a distribution around that point. That point is the middle of a distribution. If we reach a prototypical recession scenario, lower corporate earnings, higher unemployment, most likely yields on the long end of the curve should drop further. Usually the curve uninverts. Actually, I shouldn't say usually. Always the curve uninverts by the Federal Reserve cutting rates on the short end, and the yield curve steepens as rates drop. I wonder about corporate bonds and MBS. Even though the 10-year Treasury yield should drop, do you see the credit risk spread on corporate bonds? That is typically the case, that as we enter recessions, cash flow becomes an important component in evaluating corporate bonds and the state of the economy as well. So the spreads on bonds typically widen. For MBS, that's a more difficult one. If there is a credit issue, perhaps spreads on MBS may widen. But if it's not a housing problem, which I don't see it being a housing problem this time, I don't know that spreads would widen to an unrealistic extent. When I say unrealistic, I mean as wide as they were in 2007, 2008. There, nobody wanted to touch MBS because you didn't know what bonds were backing it. I don't know that MBS would widen as much as the spreads on corporate bonds would. Do you see credit risk spreads on corporate bonds and MBS will widen so much that the total yield will be higher than the current level today? Well, it should. On high yield, it should. Investment grade, that's different, right? Because you can get rates dropping on the short end of the curve and you can get spreads widening. Would spreads widen by more than rates drop on investment grade? Probably not. On the highest investment grade, probably not. So the yield would drop, but on high yield, the spread definitely would widen by more than rates would drop. So that means the price on high yield would drop significantly more on a percentage basis than it would on IG. Want to get an understanding of what factors you were primarily looking at for the TLT trade. There's only one factor to look at, and that's rates going down. If rates go down, bond prices go up. That's it. From my interpretation, would be the wage growth numbers and hours worked. Contraction in these would lower aggregate income and increase the likelihood of a recession, while also easing inflation worries, thus taking inflation expectations out of the long end of the curve. I don't know that you can get inflation expectations out of the long end of the curve much more than you already have. If we look at the break-even rates, they're all just slightly above 2%. Do you think the recent pullback in Treasury price at the long end reflects solely the market thinking that a soft landing is possible with elevated rates? If inflation expectations are coming out of the long end of the curve, that could be because the market believes that a recession is probably unavoidable at this point or inevitable, or just inflation expectations out. You can have that coming out in a slow growth environment as well. So it's hard to break that apart of which one it happens to be. I'd say if we're looking for soft landing, you're probably going to get more information out of real rates, because that at least isolates the belief about growth component. So I would look at real rates there. For this one here, talking about wage growth numbers and hours worked, I don't even know that's really what I'm looking at in terms of thinking that TLT is going to go up. TLT is a recession play, pure and simple. It's a recession play. That's the only, if you're looking at TLT at 105, 106, and you're thinking, well, 135, 140, that's a recession play. If you have a soft landing play, TLT will probably settle somewhere between maybe 103 to 109, somewhere in that range. But if you want the real upside, it has to be a recession play. It is quite rare that recessions are caused endogenously. Endogenously meaning that under its own lack of momentum, the economy slips into a recession, where everyone just gets so tired of spending and so tired of this that the consumer pulls back to the point that it creates a recession. That's usually not what happens. Typically, if the consumer is pulling back like we see now, we saw in the November retail sales, December retail sales were soft. They pull back. Well, there's cash flow that's missing to some organization out there somewhere. And then when companies start laying off, and we're seeing this through the month of January, every morning you're waking up and a new company's announcing layoffs. It was Dell yesterday, today it's Zoom. That is a typical sign before a recession, because those people lose their jobs. We've never had a job market like we have right now where everyone can get a job. But it's the lack of that income to other organizations that creates the problem. Usually it's credit led. Usually if there's no stress in the credit market, it's hard to envision a recession. So what you need is a bankruptcy that happens somewhere, or some credit issue somewhere that causes a scare, where everyone who issues credit pulls back because they say, well, what else is out there? We didn't even expect it to be there. What else is out there? And especially if there's a credit event that has a contagion effect. So you need to find some sector of the economy where credit's critically important, where there is not just one but several problems where credit in credit. And I think that will probably come from private credit. So that will cause, once you get a credit problem and everyone pulls back on credit, an economy can survive in low growth mode for quite some time. But if you turn off credit, you got a couple of weeks, and then it's over. The deterioration is very, very fast when credit stops. That's why a central bank has to step in immediately and supply liquidity very, very quickly to the market. Otherwise, it gets very bad very fast. When was the post-FOMC press conference introduced? Under Bernanke. Greenspan never did that. It was introduced under Bernanke. So I think we've got that question done. Or do we? Let's see. I've been listening to the press conference in May and feel the press conference generate more volatility than the FOMC decision itself. Well, under Bernanke, it really didn't. Same with Yellen, it really didn't. It's just Powell is... it's just not his strength. He says things that he doesn't mean to say, or in his head it means something to him, but when he says it, the market hears something else. And he doesn't think about, he thinks about what he wants to say, but I don't think he thinks about how everyone hears it. So sometimes you need to say something, and in your head what you're saying makes a lot of sense, but you have to be very careful. You have to say, okay, well, if I were in the audience and I heard that, what would I hear? So you have to be very, very careful in selecting your words. Bernanke was, he's an academic. Yellen was an economist. They're very careful about the words that they use. Powell doesn't have that training. So I think he just speaks thinking, well, I'm just telling you what I'm thinking and how it is, without thinking about, well, if I say this with the market the way it is, how do you think they're going to respond? I don't think that enters his thoughts. So if you're thinking about it generates more volatility, that's really just because of Powell. It actually was very helpful with Bernanke. What is Fed aiming to achieve through these press conferences and can't achieve through the meeting minutes and regular Fed speak? Nothing anymore, really. I think it's more harm than good, because you build in so many expectations of what you're going to do. It's hard not to follow those expectations, otherwise you lose credibility. So Greenspan was good at this. He never said anything about what they were going to do, where they were going to go. He never said anything about that, so he wasn't trapped by his own forward guidance. But this Fed seems to be very trapped by its own forward guidance and feels that it can't make a decision unless it telegraphs out some forward guidance about what that decision is going to be. But then the market just moves against the very thing they want to do. So if you're looking for what's introducing volatility, it's Powell himself. He should not. He should cancel that press conference altogether, or have the vice chair do the press conference. Why does he have to do it, right? The bond market fought, disagreed with the Fed on the transitory inflation view 18 months ago and won. Do you think the current bet or view of the bond market is that the Fed has tightened as much as required to lower inflation? Inflation is yesterday's story, while recession is today's. No idea. That's the thing with data that has a random component, is you don't know. Nobody knows. I mean, you can have, some people say, oh, it's done and it's over. You can't possibly say that. You could say, I believe it's done and it's over. But you can't confirm that it's done and over. Nobody knows the future. Not even the people on the FOMC. They don't know what the CPI read next week is going to be. They don't know if inflation is going to come. Nobody knows. So it's a matter of saying, well, you have to put your money out there somewhere, so you have your best estimate of what you think is going to happen, and you go from there. But interpretations are different because experiences are different, and education and training is different across people. So different people will see different things. Some people see exactly what they want to see. Some people see exactly what they believe. So if you believe inflation is coming down, you tend to see that. That's called a confirmation bias, but when you're subject to a confirmation bias, you can't see that it's confirmation bias because all you can see is data that confirm what you believe. So who knows on this one? There is a difference between when something shows up and when something leaves. It is not just a matter of going backwards. There is a difference in the way that happens. Do the analysts forecasting 4-quarter EPS only forecast the next 4 quarters? Pretty much. Or do they also forecast quarters for years beyond that? Not really, because anything, like even forecasting out 4 quarters is your best guess. It's a guess. And the further out you go, the more variability you're going to have. That if you're starting to forecast out 2 and 3 years, those are just going to be such wild estimates that it's really not even worth it. And how it works is, if you were doing something like that, you're forecasting earnings for a company. Typically, almost all analysts forecast earnings that look like this. Very rare does an analyst forecast earnings that look like this. But that's the market, right? But very rarely do analysts forecast that. It's usually linear. And to get an idea of what it looks like is their first forecast out will have some distribution associated with it. It could be lower, could be higher. The next one ends up having a wider distribution. That by the time you get way out here, your distribution looks something like this. So the variability in the possibility becomes very, very wide the further out you go, to the point of saying, well, I mean, it could be all the way down here or all the way up there. This is the middle of the distribution. So they just forecast the middle of a distribution, but each distribution is a random variable, and the standard deviation of that distribution widens considerably as you go further and further out, to the point where you'll get somewhere where it is nothing but fantasy. I mean, it's just, you're just making stuff up at that point, because it is all based off of a linear, some linear forecast. So because of these wide distributions, you could have, and within each distribution, you could be correct if you think, well, if I have a 95% confidence, you could have this kind of thing going on, right? It could look like that, and you could say, yes, but it was within my 95% interval, so I was right in a sense, because if I do a 95% interval and do a hypothesis test, I may find no difference from 0 based on where that center of the distribution is and what the number actually came out as. But the further out you go, you can see that you could have high volatility, and because the distribution gets wider and wider, you could say all of that was well within my forecast range. Well, I mean, what use is that at that point, right? Also, when we see the 4-quarter EPS going down on a week-to-week basis, is the fall uniform across the 4 quarters making up the 4-quarter EPS period? Not really. No, there's no reason it has to be. It could be that a company for a particular company. EPS will drop for, you know, Q4 was okay, but the guidance was low for Q1, Q2, but Q3 and Q4 were back to normal. So maybe the guidance was like this, and it's just like, well, this is gone. It'll be like this now, but these two are still okay. So no, it doesn't have to be uniform. Do you think if we get quarter-wise breakup of the four-quarter EPS weekly changes, it may help in better decision-making with regard to equity investing? You do. In one of the tabs, you can get the quarterly breakdown by sector estimates. So you do have them. Does the Fed, Powell, get to see the report and numbers a bit earlier than we do? No. Sometimes, actually sometimes. Sometimes they do if it is a number that is going to come out while they're in their meeting. They may get some information the night before, but if you were listening to the David Rubenstein interview with Jay Powell yesterday, he answered that specific question. Sometimes he does get some information, but beyond that, no, he waits like everyone else. Is there any way to short the market while keeping time costs low? You just short the market. You short, so SPY, just short shares of SPY. You will get money in your account that day. And you have to add 30% onto that. That is your margin that you have to have. But you can have that in a 30-day T-bill, right? You don't have to have your you don't have to have this in cash. You know, it doesn't have to sit in just cash. You could put it in a very marketable security like a 30-day T-bill, and you'll get the 30-day rate. There'll be a borrowing cost on SPY. And if you're short while it owes a dividend, you'll have to pay the dividend, but the income you'll make from the cash that you received should pay for that, because the money you make on just the proceeds from the short sale, which wasn't your money to begin with, more than pays for the carry. So it can have positive carry in that sense. SQQ is a bad idea. Yes, futures are volatile, might trigger maintenance margin very quickly. Well, futures are no more volatile than the underlying, so you can't say futures are volatile. If you're short SPY and you're short the futures, they are just as volatile as each other, because the futures price is nothing more than the underlying price multiplied by some interest rate factor. So every day that interest rate factor decreases. So in essence, futures are probably less volatile than the underlying, because you have that benefit of the carry disappearing every day if you're short. So they're not volatile, any more volatile than the underlying. Might trigger maintenance margin very quickly with synthetic short be the best way to go. That would do the same thing. Anytime you have a derivative, anytime you have something short, you could get a margin call right away. The only time you're going to get a margin call if you're short futures is if the underlying goes up. If the underlying is going down, you get cash deposited in your account every day. So the only time that's going to cause you grief is if you're wrong and the underlying is going up. Well, the short call will do the same thing. You still get a margin call. So you're not avoiding the margin call at all. And if you short SPY, you need another 30% of the price, because the margin for a short position is 130% of the value. The SPY, shorting the SPY gives you the first 100%, but you need to come up with the other 30% yourself. And that's 30% of the price. So as the price keeps going up, you will also have a margin call. So anytime you do something that requires a margin account, it requires a margin account because the possibility of a margin call is there. If you want to avoid all of that altogether, just buy puts. Buy puts on the index, and there you go. You're done. If you don't want to pay for all of the puts, you can buy puts at, let's say, 400, and you can sell puts at 380, and that is called a bear spread, which means the most you could make is $20 per share, and this might cost you maybe, well, depending on how far out you go, it might cost you $6 to $8 to get done. So you're, if you don't want margin, then you have to buy something that gives you that benefit. Do you think the extra detail, thank you for the extra detail in futures. I have 3 questions. If we open a short futures at 41.70, and if the SPX finishes at 41.70, we would have no loss since the two would merge at the end of the contract, right? Yep. Because on the last day of expiration, the forward price is equal to the spot price multiplied by e to the r minus q. R is your continuously compounded risk-free rate. Q is your continuously compounded discount rate, T. And if it is the last day, T equals 0, which means this whole term equals 0. E to the 0 equals 1, which means that's what you're left with. Let's see. So, like you said, we should ignore the losses on IBKR since it includes the carry. Well, so I don't look at the price. I don't look at where the futures contract price is. So if my break even is 41.20 and SPX is at 41.36, even if the contract is 41.70, I ignore the 41.70. I look at this difference right here. So I'm not down 50 points, I'm only down 16 points, because if I continue to hold, this is the thing that it's going to converge to. The rest of it every single day will decay away. All of that interest rate factor will decay away because the T over here, it might have been 120 days over 365. The next day is 119 over 365. The next day is 118 over 365. So the T is getting smaller and smaller, which means this is getting smaller and smaller. So this reality, every day it approaches that reality. So I just think, well, you know, sure, it's showing me that I'm underwater by 50 points, but really I'm only 16 points away. The rest is carry, which will decay over time. In my head, I ignore it because I have the willingness to continue to hold. If you don't have the willingness to hold, well, then you do have a true loss by the difference of where the contract is in your average price. If you sold 40-50 futures options on 50% of your positions, means you're adding positive delta to your vol. Yep. If you think markets will go up, wouldn't you want to sell another put futures? Not really. No, I know what I'm doing here. I heard you say if a market is going up, I would lean in and buy another put. Well, I didn't buy any puts. I sold puts. But if I thought the market was strong and was going to head up, then yeah, I would hedge out a bit more. So my belief is that the market is that earnings every day are showing that you know, the belief in earnings of 220 to 230 clearly are wrong. A month ago, the estimate, everyone was you know, centering around $230 for 2023. Well, we're down to $221 now, and we're what, 5 weeks into the year, and that's gone. So we'll see what the earnings estimate is this week, but I don't think it's rebounded. I think it's lower than the 221. So if things stay on this track over the course of the year, you could probably, you know, on an aggressive basis, look at earnings around 210 to 215. And if you're at 215 and you put a multiple on that, even an 18 multiple, you're 38.70. I mean, if earnings have dropped from 230 to 215, which is what, 7-8% drop in earnings, you're certainly not going to say, I want to pay 19 times. No, I want to pay 20. No, 21. No, 22. I can't see multiple expansion. Maybe you don't get multiple contraction, but let's say you're aggressive and want to pay 18, which I think is a high end on the multiple right now. At 215, you're 38.70. So it's, you know, my belief is that we have some downside, but you can't ignore sentiment. And right now, the market doesn't want to listen to anything other than the words Powell said. The disinflationary process has begun, but they turn off the TV before he says but. They say, okay, we have the sentence. They stop listening after that, and they just respond to that. Companies that report earnings that miss and they lower guidance will sell off, but during the course of the day, they fight their way back and turn into the green. So it's, when you have that going on, you can't ignore it. I'm not about to buy the market, but at that point I'd say, well, I can lower the risk of my short position without affecting my short position. So that's all I'm doing when I do that kind of stuff. And when I sell short. So I'm looking at February 17th, and the premium on the futures are quite nice. So that's what I'm doing that for. I'm not changing my mind. I'm just saying, look, the house is going to burn down, but right now it's raining. So I got to wait for it to stop raining before it burns down. But that house is going to burn down, but not in the middle of a rainstorm. And I think we're kind of in the middle of a rainstorm right now. The rain will pass, and I think the house will burn down. But while the rain is going on, why not use an umbrella? That's all I'm saying. When do you plan to cover futures and options on futures unapplied series? This is what I'm moving on to now. I'm moving on to the futures category now, along with the IPS, the personal IPS. So I'll be moving back and forth between these because these are nice and easy and fast to do. These are super fast and easy to do. And the IPS is it's long and detailed because it basically is a business plan of what you want to do. It forces you to think about what the hell it is you're doing, as opposed to just buy this, sell this, buy this, sell this. You really you have to explore yourself, and it really sort of, what you're trying to do is limit what you do to the things that you know, so that you don't get into trouble. And then it gives you sort of a guidepost to follow, saying, well, if I don't know anything about copper, I won't trade copper. Maybe I should learn something about copper first. So it sets, you know, a bar that you have to get over before you give yourself permission to trade something. So if you hear the name of a stock and you say, I have never heard that name before, but everyone's talking about it, you know, you have this checklist that says, do you know anything about it? And if the answer is no, then you've set a rule that you're not going to trade anything you don't know anything about, because if you look through your history of all your losses, chances are your losses came from trading things you knew nothing about, right? So we are moving on to this category in the next little, well, probably over the next month. I'll be filling those out. Could you explain the benefits of being delta neutral at a portfolio level for retail traders? At the end of the day, you got to have some sort of market directional view, and benefiting only from changes in vol might be a bit limiting. No? What am I missing? Well, I'm not limiting myself to just volatility. Being delta neutral is just for this particular time that we're in. If we are at a point where I believe that we are in a confirmed bull market and I don't see a lot of risks on the horizon, I see growth lying ahead, I see valuations increasing, I would not be delta neutral. I would be long and strong on beta. But at this point in time, I don't know where we're going. However, I do have long positions in my portfolio. And I have short positions, and some of those short positions are just straight out short positions. Some of them are short calls on the long position. So it is just such that if the market has this kind of volatility, my portfolio has this kind of volatility, and I like to see it climb at all times. So you know, there are limits to where I think the market can go, and as it approaches the upper limits, there's where I tend to add more short positions, because that's what I believe my directional view happens to be. As it gets to the lower end of the range, then I will probably have a net positive bias, because that's where I believe my directional view to be. It's just I'll harvest my gains at different times, at opposing extremes. But no, I'm making more than just vol. It allows me to stay in my long positions longer, and these things have an income stream associated with it. The calls generate premium in my account, which is money that I can earn. As the market pulls back, I move from selling calls to selling puts on some of these long positions. And I'll cover some of my short positions so that my beta gets long. And once I feel that we can head in some particular direction, I will just do that. So that's all I'm doing right now, is just keeping my options open, because I don't know which direction we're going in. I think we're in a neutral direction at this point in time. So that's it. Question about which sectors will outperform this year. Well, I don't know. On the one hand, with the recession ahead, or potential recession, reasonable to be invested in defensive sectors such as consumer staples, utilities, healthcare. On the other hand, stock market is forward-looking, and in the early stages of recovery, consumer discretionary seems to be the right place to be. Besides that, metal and mining and energy sectors have huge tailwinds ahead, but I'm not sure that the slowdown in demand will help them to outperform this year. So how do I approach this decision? Wow, that's all? You and how many thousands of portfolio managers are asking the same question? How do I outperform? Where should I be? What sector should I be in? And it all comes down to, what do you expect? And you have to put money in harm's way. If you do expect that there will be a recession, you position for one, and if one happens, you'll outperform. If one doesn't, you'll underperform. So it is your forecast, number one. Now, all your positions will be based on your forecast. There is no easy answer for this. It's, well, what do you think will happen? And position for that. If you're not sure whether we're going to have growth or whether we're going to have a recession, then you might want to say, well, why don't I hold a growth portfolio of stocks and bonds? And I'll hold it in a 50-50 ratio. This way here, if growth really hits, off you go. And if growth really hits, chances are inflation is not going to be too much of a problem. Otherwise, the Fed would just keep raising rates to shut down that growth, which means your duration at best isn't going to make money but won't lose money, but you'll get a yield. And if it's the other way around and growth turns negative, your growth stocks will suffer a lot, but your duration will really pay off big. And that's diversification. I have no single answer for this, and if there was an answer, the market would be one giant algorithm. And we wouldn't be doing anything but putting our money into the algorithm. Okay, this first one's a little bit difficult to follow, but I'll try to draw it out for you. Last August, I've been rolling a solid sold call vertical spread. That is selling a call at one price and buying a call at a higher price, and he notes that he's doing it with a $50 spread on gold futures, the contract being GC. Various methods that have been able to roll, usually by opening an offsetting put spread below, which means selling a put and then buying a put below with the same 50. This will give you a credit spread. This gave you a credit spread as well. That's the most you can make is a credit spread. So if it starts going up and you do this below the stock, it at least helps offset the difference between the two premiums. Let's see, this has gotten to the point now where the put spread completely overlaps the call spread, I guess because you had to keep rolling it up, which I rolled to 1920 and 1970. To do this roll, I get, okay, so the only way I could roll the credit plus no margin increase. I'm unsure how to manage this position. Okay, so this was probably a mistake to do, and it depends on let's say that let me give you I guess an easy example, and I will I'm going to minimize this this portion up here. Let me just get here so I can make that smaller so I can do something here, and I'll erase these lines. So let's say that this is your chart and you're following the price, and you have this idea that, okay, there's my call spread. I'm going to sell a call and I'm going to buy a call. That's a $50 spread, and you want the price to stay below these particular lines, and it does this instead. Well, you don't have to do anything. Let's say that you have your expiration date over here. When this gets to your expiration date, if it's still above these two strikes, we'll just extend these out. If it's still above those two strikes, you could just roll each one. At some point, if it does this, you're going to be okay. You could just continue to roll the spread. If you think, well, I'll be taking a loss, you are every single day. This is, all futures have mark to market every single day. Money leaves your account or money enters your account. You may not be aware of it, but it is. So when you decide to roll your options, and you think, well, I'll have a loss, you've already taken the loss. The money has already left your account. It's already been done. You can just continue to roll them. The goal, when this is happening, the goal is to try to get your exposure as close to zero as possible. So I don't know that I would do put spreads. You're saying that you don't want to incur more margin, so just selling a put is not really something that you want to do. You can buy the underlying, but the underlying is a futures contract, and that would require you to day trade and time it out, which isn't always the best. When I'm faced with a situation like this and I think I'm right, I was just wrong on my timing, I roll forward, knowing that eventually it's going to recover. I simply just roll forward because you're going to get time value added to both of these, right? And you're going to give up some of the spread that you had. So if it costs you 22 to get a $50 spread, when you roll forward, it might now be costing you 24 to get the $50 spread, then maybe 26 or 27 to get the $50 spread. But you know, if you keep rolling up puts to cover it off, and it does do something like this, now you're in trouble on the puts. Whereas it's better to be in trouble on one position, and each day that you lose money, your account loses that money that day. So it's not as if you'd be taking a loss. You've already taken the loss. Every single day at 2:30, whatever that number is, by the end of the day, that money leaves your account. It is gone. You've already taken the loss. So rolling forward doesn't mean you're going to take any more loss. You've already taken it. The money's already out of your account. So I would just continue to roll forward on that one. And really, the most that you're going to risk is 50, no matter what. Well, whatever you originally got for the first one, up to 50. So no matter, even if it does this and you continue to roll, it should be almost a money for money roll every time you roll it. Current level of OAS, it is almost a no-brainer for U.S. citizens living in states with state or country income tax to invest in less than 3-year treasuries over 3-year investment-grade corporate bonds due to the slight incremental yield pickup from tax benefits. From tax benefits? I don't know what you mean from tax benefits. Interest is interest no matter how you earn it. There is no difference between interest on treasuries versus interest on IGs. Unless you mean that you're going to use muni bonds. Munis are tax-free, but they're going to have a lower yield because they're tax-free. So I'm not sure what tax benefit you think exists there. I'm unsure of it. Do you know if there is a way to find forward 4-quarter EPS for each sector of the S&P within Refinitiv? No, just go to S&P Global. If you look in the last Market Outlook, you'll see a link for a spreadsheet for SP Global, and on one of the tabs it breaks it down by quarter, by sector, so it's by quarter, by sector. Okay, applied series, top-down rates and spreads. You stated that when the yield curve is inverted, it's a good idea to add duration. Why? Because inverted yield curves resolve themselves, always resolve themselves by short end rates dropping. So if you have a yield curve that looks like this, it usually ends up resolving itself by doing this. So rates drop at all parts of the curve. Rates on longer bonds are already pricing in at lower rates. Shouldn't it be better to buy shorter term bills that are yielding higher rates? So this is the difference between value and growth. You know, if you're on the short end of the curve, you're investing for value. If you're on the long end of the curve, you're adding duration for growth. Value means you're going to get a nice yield off of this. Growth means you're looking more for capital gain off of this. And when rates drop at the short end of the curve, you're really not going to get much on a capital gain because a 6-month treasury has almost no duration. And if it has no duration, the percentage change in the present value of the security itself will be very close to zero, which means you're really just getting, what, 4.6% the yield? Whereas on the long end of the curve, you'll get a lower yield in exchange for the higher potential capital gain because it has a very high duration. So you can think of the long and the short end of the curve as the value area of the curve and the growth area of the curve. Currently doing L2. I want to be an expert in REITs. Can you share some advice on analyzing, understanding these? I have in the applied series. In the sectors, I spent a lot of time on equity REITs, and in bottom up, I spend time with agency and helping you understand how a mortgage REIT makes money. So how you would assess any mortgage REIT. If you know how to assess one, you know how to assess all of them. Fed has two mandates. Labor market, well, not really labor market, it's called full employment, right? Price stability. Let's assume labor market remains strong throughout the year and we dodge a hard landing. In that case, Powell would have little incentive to cut rates anytime soon and will be in a higher for longer scenario. Yep, that's what he said to David Rubenstein on Tuesday. Considering that the market has priced in some rate cuts in the second half of the year, then the market would need to reprice that back, leaving us with higher, longer end curve and higher dollar. Well, if we look at Fed funds futures, they are now below 95. I saw this morning the August was 94.87 something, and the December contract was under 95.10. I think I saw it as low as 95.07. From what was it, 95.50, 95.45 just a week ago. So that is huge. Yeah, the market is pricing out these rate cuts for the year. And the dollar stronger, marginally stronger, not so significantly that it's surprising, just a little bit. I wouldn't say stronger, I'd say it has been firmer, but I wouldn't say stronger, more firmer. Okay, first question. Chart of LQD shows a much higher volatility than that for HYG for the recent years, which looks a bit odd. Shouldn't high yield be much more volatile than investment grade? These aren't stocks. You can't compare them that way. So a stock is a perpetual security. So you can look at a portfolio of IT stocks and compare it with a portfolio of utility stocks, and you can compare that. Bonds, you cannot do that. You have to look at the age of the bond in the, or at least the term to maturity of the bond. So three ETFs here, GOVT, LQD, and HYG. Government bonds has a very low volatility, 5.6. LQD and HYG, this is the last 3 years, have about the same, pretty much the same volatility. Look at the difference here. LQD has a duration of 8.59. HYG has a duration of 3.86. This, right away, will make it more volatile because the percentage change in the present value of the portfolio, the full price of the portfolio, is equal to negative effective duration times the change in yield. Considering that there's one yield curve and we're looking at the change in yield, the larger this is, the greater the percentage change in the price of the bond. LQD 8.59 has a much higher duration than HYG. So you can't just say, well, high yield should be more volatile. Not if it has very low duration and the other one has very high duration. So you're sort of missing that big thing with bond portfolios is you can't just look at the type of bond being held. You have to look at the effective duration of the portfolio itself. Can you explain more why you favor selling puts on futures at 40.50 instead of just closing 50% of the futures contract so I can understand it better? Well, why would I? I'd be closing it at a loss. So my average price at this point in time when I did this was 41.20. So 41.20 down to 40.50, right, gives me 70 points per contract, and that's only on half my position. Plus I got money for selling at 40.50, which means I get that all the way down as well. So it's just a way for me to say, okay, I'm short the market, but I recognize that for this week or the next couple of weeks, the market's probably not going to move in my favor. So why not do a little bit of risk management? That's all I'm doing. Just in case I'm wrong, let's put a little bit of risk management into play. That's all I'm doing. I see you're looking to increase your carry, which would increase your break-even point. That is true. But then if and when markets go up, I think you mean down, the short put option on futures contract will work against you. That doesn't work against me because if I hold it all the way to expiration and I have the futures contract put to me, I get the 70 points difference between 40-50 plus I get all the premium. at the same time, and that's only on half the position. And normally, as markets are selling off and moving down, I lower my negative position. Not lower as in get more negative, but I reduce the amount of negative position I have. So as the market is going down, I reduce my negative position. My positive beta position starts showing up, so that when I think we're getting to a certain point, I have net positive exposure. So it just plays into where what I would do anyways. I have no problem with it being put to me. And because I still have plenty of room in there, I got 70 points before it hits the 40-50, and I got a bunch of points on the 40-50 as well. That's a pretty good return for just saying, okay, well, I'm just going to manage some risk at this point. And I would have closed some of those futures on the way down anyways. So that's all I'm doing. I was reading a book this week about understanding financial statements with managers and entrepreneurs. It's surprisingly stated that in practice, investment professionals first look at the balance sheet. Investment professionals. Well, what type of investor, right? As a former PE analyst and now corporate M&A analyst, I always look at the income statement. Well, if you were a lender, you probably look at the balance sheet because you want to see what are the quality of the assets that are there, and are there more assets than there are liabilities? That's the first thing you want to ask. And what kind of assets are there? What is the so that you can think about if I had to collect on this company, are there assets there that I can take that would pay off my debt? So you'd probably look at the balance sheet first. And if the balance sheet didn't pass muster, you would say, I'm not going to lend to you. But if there wasn't much on the balance sheet, let's say it was a services-based business that had a lot of IP that was internally developed, well, that never finds its way on the balance sheet. Then you'd probably be looking at the cash flow statement, not so much the income statement, but the cash flow statement, to determine whether or not they can service the debt. Well, what is their cash flow from operations? Can they service the debt? Some ratios are done with the income statement, but I think the more useful ones are done with the cash flow statement, because you can have an income statement where you have very low income. Your net income is very low, but your cash flow from operations is very high. If you were asset heavy and you had a lot of depreciation, or if you were IP heavy and you had a lot of amortization. If this is for externally acquired IP. So the cash flow tells you how you can service the debt. The assets tell you how you can collateralize the debt. If you were I think an investor in a business, I think the income statement and the cash flow statement are far more important than the balance sheet. Not that the balance sheet is not important. It's just I think that the income statement and the cash flow statement are more important. Just to rely on the income statement, I think is I don't think is enough, because the income statement is a reflection of accounting policies. The cash flow statement is a reflection of economic reality. There's a lot of policies and a lot of choices in the policies you use to construct an income statement the way you need it to look, but cash either shows up or it doesn't. So I think the cash flow statement is more powerful in terms of giving validity to the income statement and judging the quality of the earnings. And if the income statement is good and the cash flow statement is good, I think it's worth having a look at that balance sheet. But I don't know that I would start at the balance sheet. I don't know that I would start there if I were analyzing a company. But then again, it depends. It depends on, is this the very first time that I'm seeing this company? And if it is, then I want to get an idea of what assets it has, because that'll help me to determine, or at least understand, its business model of how it makes money. So, yeah, I don't know that there's one, that's more important than another. I think for credit investors, the balance sheet followed by a cash flow statement is probably primary. For an entrepreneur, it's a cash flow statement always the cash flow statement, because as an entrepreneur, you don't manage the business for net income, you manage the business for cash. You get effective and then you get efficient. So your focus is always on the cash flow statement, and then later you move it to the income statement, and you're not too concerned about the balance sheet. You're trying to stay as balance sheet light as possible. So you tend to outsource a lot of stuff that you need done because, again, you're managing for cash, not profitability, right? So you try to keep as light as you possibly can. So for the entrepreneur, I think the cash flow statement is more important. For the investor, again, it really depends on what you're investing in, how familiar you are with the company, the type of assets it has. If you're looking at financial-based companies, like banks or mortgage REITs, you pretty much have to start with the balance sheet, I think. Yeah, I think you pretty much have to get an idea of what assets you have because they're all financial assets. For some REITs, I think the assets are important because that's, are we dealing with Class A properties or Class B properties? Where are they located? Are they geographically concentrated? Are they dispersed? There's no easy answer there. That's a long answer, but it depends. Okay, I've separated the two comments here. Buffett Munger publicly stated they thought the notion of cost of capital made no sense. I never heard them say that, so I'll just take your word that you heard them say that. I don't know if they did say that or that's what you think you heard. I'm not sure if I correctly get their point, but I think it's really the CAPM they do not see as economically relevant. Well, CAPM is not cost of capital. CAPM arrives at, you could say, a cost of equity, but it's not your cost of capital. Cost of capital is from all sources of capital. I'm not really familiar with the investment philosophy of Buffett Munger, but I believe they said they view the discount rate as an opportunity cost, which it is. Discount rate is the opportunity cost, and the appropriate opportunity cost is the current risk-free rate. Well, that would be hard to justify, right? Is saying the current cost is the risk-free rate. You could argue that the cost of taking on risk can start with the risk-free rate, that if you have a default-free rate that you can get, that is the starting point for assessing the risk that you're taking on, is that. And it is a starting point for everything. Even CAPM has the risk-free rate plus a beta times an equity risk premium. Even a bond buildup has, the corporate bond yield, which is made up of the risk-free rate plus a credit spread plus a risk premium for equity. So everything does start from the risk-free rate. What do you think about the notion of cost of capital / CAPM? These are two different things. So cost of capital, you have a weighting that you would use on your cost of debt. And since you can deduct debt, you'd have 1 minus t, plus you have a weighting on preferred shares times whatever the cost of preferred is, plus you have a weighting on your equity times the cost of equity. CAPM is just one way of figuring out this variable right here. You still have all the other variables, right? And it's only one way of determining that variable. Criticism of CAPM is twofold. Number one, it's an equilibrium model, which means that it makes an assumption that markets are equilibrium. Number two, it is a one-factor model, which means that it accounts for its returns purely from one factor, which is beta, which is the equity risk premium, as opposed to getting it from multiple factors. So the criticism is justified. Do you see any validity? I see validity in criticizing CAPM as being limiting, but I don't see any validity in suggesting the cost of capital is the risk-free rate. Because there are all sorts of levels of risk, and unless you know what the cost of your capital is, how do you know if you're investing it wisely? When you say the risk-free rate is the opportunity cost, you could invest in investment-grade bonds, right? You could invest in investment-grade bonds, but you do something else. Well, doing something else, the opportunity cost is, well, you could have got the yield on investment-grade bonds, which was higher than the risk-free rate. So your opportunity cost is what you're giving up to do something. So it's not that you're always giving up the risk-free rate. You could give up other things to do something. So I don't quite agree with leaving the opportunity cost as the current risk-free rate. They followed Graham Dodd very closely, and Graham Dodd used a particular function of the risk-free rate, 2 times the risk-free rate, 1 over. And that would be the appropriate multiple to pay for an equity. So if the risk-free rate was 5%, then 1 over 10, and this was their thing, 1 over 10 equals 10%. The inverse of it, this would be 0.05. So 1 over 0.1 equals 10. You'd pay 10x multiple on the market, or 10x multiple for an equity. Call it a broad-based equity portfolio 10 times. If the risk-free rate were 5%. That is a sort of a shortcut that if you read The Intelligent Investor, you'll find that. So maybe they have some variation of this in their particular model. I don't know. What happens to defined pension if company goes bankrupt? Nothing really. So you have a company over here, and here is the special purpose vehicle, called an SPV or an SPE, and the company makes donations over here, and all the assets are held here, and this company here pays the liabilities, which are the pensions that they have to pay. So if the company goes bankrupt, this all still exists. The assets exist and the liabilities exist. The only problem is this company no longer can make donations to the pension fund if it were underfunded. Typically what happens when a company goes under is whatever assets are here, the fund manager here heads to an insurance company and buys annuities for the pensioners, because an annuity makes a stream of payments until the person dies. So it is pension-like, and they'll just buy a whole bunch of annuities. And if it's underfunded, well, then the pensioners don't get their full pension. They'll get something less than their pension. But that's typically what would happen if the company goes bankrupt. It moves from employees to the next company. No, it would just be folded into, we'd call the frozen plan, and probably would be folded into annuities. Pension fund is underfunded, the pensioners lose. That's the end of it. What rating of high quality corporate bonds are usually used? I think it's just an investment grade rating as a group. Whatever investment grade, whatever the yield is on a broad investment grade portfolio. Duration of these bonds should be similar to the pension liabilities. Well, that's going to be hard to do, as you say down here, hard to match liabilities, because a pension fund could have a perpetual life. So it would just be a long-term, the rating on a long-term IG. And in most cases, for investment grade, if we look at a term structure, 1 year, 2 years, 3 years, all the way out, it's usually slightly upward sloping. So it would be a higher yield than a short-term yield, but still an investment grade yield. Are pensions anyway an important aspect of analyzing a company? They can be, but only the defined benefit plans, but they can be. Have you ever heard about any cases where pension caused a bigger issue? Or we should treat it as another accounting detail? Yeah, when legacy companies, and when I say legacy, companies that have been around like 30, 40, 50 years, and they had defined benefit plans, all of those when they carry those on their balance sheets, they're what called legacy costs. Even if they switch to defined contribution, depending on the size of it, it could be substantial, a substantial hit to cash flow. So that when times turn a little bit tough and they take a hit to cash flows, well, those pension contributions, especially if they're at a minimum regulatory threshold, still have to be made, and that could end up hurting a company significantly. If we look at the car companies before the financial crisis, I mean, they went into almost bankruptcy at that time. They had to get a bailout. The pension, the contribution to the pension plan were significant. They were significant sources of cash flow. So yeah, they can cause a problem. Why is the Taylor rule not used to ascertain where interest rates could finally end up? Would such a determined rate not be higher than the current short-term interest rate and headline PCE of 5% altogether? Why is this approach not used or apparently much referred to in public debate? It's more of a, I don't know that it's a rule that they follow as much as, oh, hey, there's this, prescription of how we can set the policy rate based on where the neutral rate is and the output and the inflation gap. It can help inform a decision, but there is a flaw in using it, right? You can't use this 5%. You have to think about a timeline, and here we are on the timeline. This 5% is inflation over the past year. Interest rates are for the period ahead, not the period behind. So an interest rate here of 6% says you'll get 6% on your money for a period of time. So you can't compare these two things because they're looking in different directions. So if you were going to use the Taylor rule to come up with a policy rate, you have your, sorry, that's an equal sign here. You have your real neutral rate, plus you need your expected inflation. That's the first term. Well, the expected inflation has to be what you think this would be. And this R star is theoretical. So your first step is, well, what is R star? And what is the expected inflation rate over the next 12 months? I don't know. So you're starting from two wild guesses. I wouldn't call them wild guesses, but guesses, because they're not empirically driven. They are theoretically driven. And then you are adding, you're weighting the real output gap and you're weighting the inflation gap. So you may have a target, and they know that this target is 2%, but this is actually T. This is expected inflation. Well, what is expected inflation? You can't look backwards, you have to look forwards, because a rate is set for the future. Well, what is the expected inflation, right? And then you have your potential GDP, which is based on a bunch of assumptions as well. And then you have your current GDP. So you have our GDP, which is actual, minus our GDP, which is potential. Well, that's based on assumptions. This is a guess. This is assumptions. This is assumptions. So it's a whole bunch of assumptions, to get to what a policy rate is. Well, if you're going to start putting a whole bunch of assumptions out, why not just say, hey, how do we feel today? And do it that way and say, this sounds good, that sounds good, because that sounds just as good as making a whole bunch of assumptions, right? Where does one get OAS data? You can go to Google and you can type in IGOASFRED, and it will give you the IG spread. Then change this to high yield OAS, and it'll give you that. And then you can type in AA, you can type in B, you can type in CCC OAS Fred, and it'll give it to you each time. So you could just use that. Explain how investment grade bonds are overvalued based on the forward curve. So when you're looking at a forward curves, you have the 1 year observed rate, and then you'll have two. Let's just take a 3-year bond. This is the current 1 year rate, and this is the forward rate 1 year out, and this is the forward rate 2 years out. You can discount a bond by discounting it back 1 year at a time, right? As opposed to discounting each of the cash flows by the respective spot rates, you could just discount them by the forward rates and you should get the same price. While if you have an inverted curve and you're discounting this one back and then your cash flows 3 years to get to a present value, if you feel that the forward curve, the rates in the forward curve are too low, well then they'd have to be discounted at higher rates. You discount at higher rates, you get a lower present value. So unless we have a recession where rates drop significantly, if we have higher for longer, investment grade bonds are overvalued because the forward curve has rates that are significantly lower. The 1 year rate 1 year forward is significantly lower than where the Fed has, sort of telegraphed where it would be unless there's a recession. How will we know recession is here? What parameters to look for? If you have the applied series in the top-down folder, there is a video up now called contraction, and it will give you a whole bunch of indicators to look for. And the more indicators that have are showing a recession signal, the higher the probability of recession. You'll know you're in a recession because everything's negative, and unemployment is rising. GDP is negative and unemployment is rising. Those are the two big things. What would be the outcome showing we're in a recession? I just did that. Let's see, PVC waterfall. So what would be some of the outcomes of recession in your view? And again, if you have the applied series, the contraction videos in the top-down sector, in a recession, you'll know it. It's one of those things where, you know, forecasting the contraction, forecasting a recession is very difficult to do. But when it shows up, you'll know you're in one. Can you go deeper into how seasonality is calculated using a math problem as an example? It's I can show you a model of it, but not a math problem. How you would do it is a time series task, right? Is the sort of outcome you see in time t, you have some idea that it is associated with the outcome from t minus 1. So it's you're just regressing the series on its past values, and then you look at your errors. You know, if this is monthly data, you would look at the first 12 errors and you would see if any of them are significant, and usually where they're significant, there's the possibility of adding a lag. So it's hard to argue that there'd be a lag every 7 months. Where's the theory that says there's a 7-month lag on anything? So usually if it's quarterly data, it'll be the 4th lag that is significant. If it's monthly data, it'll be the 12th lag that's significant. So you would just send for seasonality. If it's monthly, you would add another variable t minus 11. So this is t minus 1 is the 1 period behind t minus 11 is this is month 1, this is month 2 back, this would be the 12th month back, or is it t minus 12? This is t minus 1 is January, yeah, t minus 12, sorry, it would be t minus 12, because if this is January, then you have to go back to the last January, and this would pick up any seasonality, and then if this coefficient is significant, it would pick up seasonality. So then you're able to use last year's January number plus the month before, you know, to look at the value in this particular month. There may be more lags. I mean, they may use all 12 lags. I don't know, but typically, I'm just giving you a rough example. Is you simply just add an independent variable that is either the 4th quarter or the 12th month. You simply add a lag, and as long as you have no significant errors, then you have a model that is predictive. Well, that should be close to being predictive. I'm giving you a very simplified look at it. This is the simplest way you account for seasonality is you add the seasonal lag. But if you have something like sales for a company, and you can look up sales for a company, and if it's a consumer, retail company, you should see Q1, Q2, Q3, Q4. Q1, Q2, Q3, Q4, you'd see this kind of pattern in sales. And here's Q1. You can see that Q1 is growing. But if you didn't account for seasonality, you'd look at quarter over quarter. If you map the growth rate, you'd see something like this on the 0 line all the time. And you'd say, well, growth is, you have all this 0 growth. It's because of the seasonality. So if you were forecasting sales here, you'd have, your Y variable would be sales in period T is alpha plus beta. Maybe there is some sales in T minus 1 because there's some momentum to sales, that last period sales help explain this period sales, that if you knew last period sales you could forecast. But if there's seasonality, you would also add B4, if this were quarterly, sales T minus 4. Well, actually that'd just be B2 because B1 and B2, but it would be T minus 4 to grab the last quarterly sales, so that if it catches this kind of thing, and it'll catch Q1 to Q1, Q2 to Q2, Q3 to Q3, so that it's always grabbing the quarter that is last year's quarter and adjusting for any seasonality quarter to quarter. So it just smooths this out so you don't have this kind of sawtooth pattern. I heard an argument about consumer balance sheet and expectation of recession. Because recession has become consensus, consumers are more cautious in their spending now. Consumer spending decrease leads to retail sales drop. However, you see higher aggregate income and people spend less. The consumer savings are actually increasing. Well, that's not really what we're seeing. You had a slight increase in consumer in savings in the last reading, but before that you had one of the lowest savings rate in a long time. Expectation of recession shapes consumer behavior, might actually not lead to a recession. What do you think about this viewpoint? I don't think much of it. It's rare that you get an endogenously led recession. Endogenous means that there's no external event, there's no negative event, that the economy just falls into a recession under the weight of its own actions, that the consumer gets fatigued and they sort of stop buying, they increase their savings, and this causes businesses to lay off people and cut back investment and that sort of thing. That can lead to stagnation, but it's very rare that on its own causes a recession. Usually it's some external event or some credit event that causes a push out of whatever equilibrium you have to be in. Stagnation can be an equilibrium, but it causes a push out of that, which then causes a lot more to happen a lot faster. But endogenously led recessions are very rare. Usually you get long periods of just stagnation if it's going to be something that's endogenous like that. I'd like to dive a bit deeper into your comment when discussing that REITs react more to real rates and nominal rates. From my understanding, market value equals NOI or R minus G. Property value equals NOI R minus G, and what we've seen is market values being bid excessively year to date. That's because real rates have been dropping. Meanwhile, the higher for longer prospect means that R will be increasing, or at least not decreasing, and inflation should decrease, which likely means that NOI flat, decreasing. I don't know why you think NOI will be flat or decreasing. And G decreasing. I don't know why you think G is decreasing either. They could, but it doesn't follow. You know what I mean? It's not like if A then B. It's if A, it may create the conditions that lead to B, but it doesn't necessarily have to. So we're left with a flat numerator and increasing denominator that should put pressure on market values. Well, let's just take your R minus G and break it down. This is a real rate plus an expected inflation minus, and G can be broken down because that's nominal as well. In the long run, we could say it's a real GDP plus expected inflation because that's nominal GDP, right? Well, plus, minus, those things cancel out. You're left with real terms. So they cancel out of each other. So the expected inflation really doesn't have that much of an effect unless the expectation for inflation does not get priced into the nominal rate and real rates get pushed down as a result. That will push up property values. So that probably answers your question. I don't think we need to go into this. The cap rate is really just R minus G, and we've taken care of it here. Any thoughts on increase in retail investor trading and the rise in meme stocks? Seems to make even less sense than the craze we had during the bull market of the pandemic. So for the rise of retail trading, for the rise of anything like this, like that kind of thing outside of a profession, you need two things. You need accessibility, number one, and you need community. So accessibility, this really started happening in the late 90s, early 2000s with the rise of things like Scottrade. And then I think E-Trade followed on from that, and all of these discount brokerages just started proliferating so that the average person could suddenly start trading stocks and get a data feed for nothing, for free. If it were the early 90s, you had to buy a particular terminal and you had to pay significant amounts of money for your data feeds because there just weren't those kind of brokers. So if you wanted to be a serious retail trader other than calling your broker, it cost a lot of money. So accessibility was low. So it really was a professional field. But once you get accessibility, well, then almost anybody can show up. But if you really want to make something of it, create community. When you create community, you create a herd. Now you have a herding mentality. Well, you got Wall Street Bets on Reddit, and you've got different social media venues now, and different groups. Now there were always chat boards. Even in the late 90s, you had chat boards dedicated to particular stocks, but it was really just a bunch of sleazebags in the chat rooms. Nobody really paid attention to the chat rooms, and they weren't really big. It wasn't a big thing, but they did exist, but they just weren't a big thing. But now, community is huge. So when you take accessibility and you combine community, then you get herding behavior. And that is I guess you could overlay that with inexperience. And when you have inexperience, you'll have that herding behavior. The more experience you get, the more you start moving away from the herd. But the retail investor rarely gets to the point of experience because that also requires education as well, and that just sits outside of the community aspect. Especially today with TikTok and short videos, Instagram, and direct messaging and instant messaging and instant this and instant that, and we live in an instant world where education and experience just isn't respected. You sort of just want to get it all right away, right now. I'm seeing on Reddit a whole bunch of people making money by doing this. I'm just going to do the same thing, and then I'll be able to post pictures of my Lamborghini as well. So these two things here, accessibility and community, if you're ever trying to build a business for something, you got to break those two things. If you want big audiences, you have to solve the accessibility problem and you have to solve the community problem. And if you can get those two things right, that's all you need. People will naturally just show up. The reason this part here rarely ever happens is because most of these people lose their money in 3 to 6 months. If they're unlucky, they'll start investing in a bull market, and they will confuse luck for brains, because in a bull market 90% of stocks go up. So you'll start confusing luck for brains, and you won't stop until it's all gone. Because you'll think you're smart. You'll think you'll have it all figured out. So if you're 22, 23 and you think that you've got it all figured out, where people who have been at this for 30, 40, 50 years still find it a challenging environment, and you've been at it for 6 months and you've got it all figured out, you're a ticking time bomb waiting to blow up. You're a ticking time bomb. If there was a way on Robinhood to say, I don't want to short Robinhood, but what I'd like to do is the sum total of all these retail accounts. If you can create an index, which is the sum of all the dollar values of all the accounts, I would short the hell out of that in an instant, without thought. You give me an index that is nothing but the sum total of all retailer accounts, I will short that all day long. I will borrow money to short that all day long, because 95% of these people will lose their money within the first year. Half of them will be gone in the first 3 months. That's how quickly they disappear. Lots of research to back that up from other brokerage accounts, academic research where the academics have gone to different brokerages and said, can we do some research with your data that shows that most retail traders are out of business 3 to 6 months after they start. I hear CNBC say that on day X, this big rally on the NASDAQ was due to lots of short covering. How do they come to the conclusion that that much of the rally was due to that and not simply due to more long-only funds entering the market? For this one, it's you can look at volume, and if you have a market that's, let's say, a market that's done this and it starts doing this, and you see this kind of volume pattern, volume is dropping as this is increasing. This is probably the first 2 days of the big spikes is probably your short covering, and then there's a little bit of momentum left over, but the higher it goes, volume is dropping off. If you look at all the rallies that we've had since the bear market has begun, it shows this pattern, including the one that we're in now. Volume is that as the market went higher, volumes kept dropping and dropping. That is a good sign that the shorts have covered their position, and there is not a lot of institutional money coming in, not a lot of long money, long-only funds coming in, because as the market goes higher, you'd see volume increase. When you see a market moving up and you see a volume pattern that looks like this, that is something that you want to pay attention to. But the other way, what are your thoughts on doing a course on complexity theory? That is a big undertaking, and I was a student of complexity theory and chaos theory, and I still am. I enjoy reading stuff on this, and especially when it crosses over into things like economics and finance. But I am in no way an expert on complexity theory, so I would pass on that. And I would say if you use YouTube and you type complexity theory university course, you'll probably find some good videos out there. Also, when can we expect new content on your website? I just put the contraction website up, the contraction video up in the top-down folder. And due to popular demand, I'm going to move over to futures because they're super fast and super easy to do. And on the IPS, the personal IPS, which is easy to do, but long, because there's a lot of decisions that you have to make about how you're going to conduct yourself. If you operate by rules, you'll stay out of trouble. If you operate by rules, and then the better you get at following your rules, you can start relaxing your rules to have wider parameters, so that your the allowable activity that you do is a direct function of the experience that you get, so that you stay out of trouble. So if you've had a history of, hey, I make money and then I blow up, and then I make money and then I blow up, and then I make money and I blow up, let's get rid of this stuff. Let's get rid of the blow up stuff, and you get rid of that by following certain rules, right? You recently posted on LinkedIn, you mentioned the market was fighting the Fed. Fighting the Fed by loosening financial conditions. So the Fed had said higher for longer, higher for longer, higher for longer. And we looked at the Fed funds futures curve. It had this kind of dip, whereas December was showing already 2 cuts, 2 times 25. And then 2024 was showing another 150 basis points in cuts. That is basically saying to the Fed, we don't believe you, basically openly fighting the Fed. When the market rallies, leverage gets lowered. And when leverage gets lowered, you have more capacity in the market for borrowing. So it's openly fighting the Fed. And there's an old statement that says, don't fight the Fed. And back in 2020, when I started putting the videos up related to the market, the applied series related to the market, I remember the first 4 or 5 that I put up, my warning in them was very clear each time: do not short this market. It was right in the middle of the pandemic. Everything was shut down and the market was going up, and I said, do not short this market. The Fed is right behind you. Don't fight the Fed. Don't short this market. You'll get crushed. Well, here it's the other way around. The Fed wants to keep rates higher for longer, and they want to crush inflation in the services, ex housing. And if you listen to Powell in the press conference, he says we do not see disinflation here. And when he had his David Rubenstein interview yesterday, he repeated that again. We do not see it here, and this is where we're looking. And we do not see it here. So in this case, I would say do not go long this market because the Fed is quite adamant about this. And that's what I mean by openly fighting the Fed, is hearing what the Fed says. Well, not even hearing it, listening to what they say, but then hearing only what you want to hear. It seems as if everybody turned off the press conference and turned off Bloomberg as soon as they heard Powell say the disinflationary process has begun. Click. Thank you. They didn't listen to hear the word but. They listened to everything before the but. You should know that nothing before the but matters. It's only after the but. All right? And the explanation of the volatility Tuesday, February 7th. You got a lot of algorithms that are running in the market, and sometimes you have these algorithms that will scan text and looking for keywords, and then they give a buy or sell rating based on the probability, based on that word having shown up in the past and the outcome that happened because of that. They place a probability on certain words being bullish or bearish, and that sort of kicked in, which when the market starts rising like that, those who took short positions, especially day traders who took short positions, tend to trade out of that very quickly. So you get something that looks like this, only to come right back down again. And it did, came right back down. And by the end of the day, the market got together and said, we really don't give a shit what he said. We have our own idea of what's going on. Yes, some companies have missed earnings. We don't care. Yes, there are layoff announcements every day. We don't care. Yes, he said rates higher for longer. We don't care. But on this, volume, again, was decreasing. And then the next day, Wednesday wasn't that great. Today was, you could see it in the market. There was no real desire to go much higher. And then after the bell, you've had, two more companies announce layoffs? You had one last night, one this morning before the open announced layoffs, two more after the bell announced layoffs. Every single day layoffs are coming. That is a leading indicator of the recession. When you start getting layoff announcement after layoff announcement, especially in an earnings season, that's a big deal. Which I felt nothing for the market to react to. You're right, you're nothing. And when you feel this, when you have this, you have to have courage. You have to say, there's nothing here, I'm going to short. Take a small short position. Short even 25 shares of SPY just to be in the game. Take a short position on your feelings and see what happens, or sell a call, or do something small just to be in the game. Short 10 shares of SPY if you don't want to take on a lot of risk, but you just want to play your intuition. You want to play your instinct, because I'll tell you, nothing feels better than looking at something saying this doesn't feel right, making a bet and being right that it wasn't right, that you followed your instinct and it was right. The more experience you get, the more you start to trust that little feeling in your gut that says, this doesn't feel right, this just doesn't feel right.